Hello, everybody. Welcome to Thursday. The S&P 500 was up 0.75% today. A really good day, actually. We bounced right off of the trend line that we've been kind of holding up on since the low of mid-October. And we had some good news today about wage growth. Indeed, which is the company that does job listings, put out a report today saying that the growth in wages was back down to where it was before the pandemic started, at least in their data. And most of the times people would see that as a bad thing, but in a high inflationary environment, the growing wages are one of the big issues. And of course, the jobs report that just came out on last Friday, the growth in wages was quite higher. So this contradicts that, although this is a bit more forward looking because these are open jobs that are happening right now, which I think is kind of interesting. Oftentimes, labor data is delayed compared to what's happening to the economy because it just takes so much time to actually hire somebody or so much time to lay somebody off. So we have to be a little bit careful about putting current, labor data into current thinking about what might be happening with the stock market, which is obviously looking forward as far as that goes. We're seeing mortgage rates come down. I think that's somewhat supportive of the economy itself. Also, Jim Paulson, one of the big hedge fund managers today, came out and said that he expected to see a 25% return in 2023. So there's some things that are happening. Again, there's going to be this big battle next year between people that think the markets are going to fall apart because recession is going to be much deeper than expected. And then there's another group that thinks that there's enough good pieces in the economy that might hold it up. A little bit about what I talked about yesterday. I'm not really picking a side in that fight. I don't really believe in trying to predict what's going to be happening per se. I like to look at both paths and try to make sure that I understand all the different paths that are out there and then create scenarios for how we react to those. So again, right now we're 3/4 invested, from what our normal allocation is in the stock market, just because we are on a nice upward trend here altogether. But if that breaks down, we would change that. If that continues forward and gets through some of these other barriers, we would actually add more stock to the portfolio as far as that goes. So tomorrow's a big day because we have the Producer Price Index, a PPI, that comes out. And again, this is another inflationary measure. And then, of course, we have the CPI next week. We love our acronyms, which is the Consumer Price Index that happens. And both of these are going to be data points that the Federal Reserve is going to get before they meet. And then they end up with their, question and answer session next week, right after we get the CPI the day after. So a lot of things happening right now. Again, I still think the big focus is going to be more and more on, what happens with recession. Although now in the very short term, I wouldn't be surprised to see a pretty good focus on the inflationary situation because of these reports that are coming out. But overall, I think we're going to see, move past that and start talking more about what happens with the recession and how that plays out. So some good things are happening that are important to understand. But obviously, there's some risk on the table here that we also have to look at as far as that goes. So look forward to being able to talk to you tomorrow. I do my show. I do a summary of what I saw happen in the market at the beginning of the show. That's a Talk Money with Tom on YouTube. You can come live from 12:15 to 1. We answer questions live. If you have some, you want to throw some our way, we'd love to hear them. And look forward to seeing you then. Thank you very much.